Good morning, sir.
Good morning.
Good morning. You all can hear me?
Yes.
Okay, good. Any questions before we start? Any question on what we discussed last week about foreign exchange? No questions? So then shall I ask some questions? Okay, if you don't have any questions, that's good. But today we are going to start risks in foreign exchange. I think you can see the presentation. Is it correct? Can you see the presentation?
Yes.
Okay. However, before I move into this presentation, I just revise what we discussed last week. We started with an introduction to foreign exchange market. Why do we need foreign exchange market? So basically, to finance the global transactions, we need foreign exchange market because exporters and importers, they have to convert one currency to another currency. So that's the major requirement of, or the need of the foreign exchange market. But with that, other ways come into the picture, that like investors and speculators started to trade in the foreign exchange to make profit when the exchange rates move. Then we discuss what is the exchange rate. It is the price of one currency in terms of another currency, or you can say value of one currency in terms of another currency. Then we discuss about few terminologies used in foreign exchange market. First thing we discuss base currency and counter currency. Hope you can remember what is the base currency, what is the counter currency. Then with that we discuss direct quote and indirect quote. Practically, how do we identify a direct whether a quote is a direct quote or an indirect quote? Then we discuss two-way quoting, bid price and ask price. Okay, what is bid price for the bid quote? That's the price where which market maker is willing to buy the base currency. The bid price is the price at which the market maker is willing to buy the base currency. Offer is the price at which market maker is willing to sell. So bid is lower than the offer. Then we discuss spot, term, cash and forward. What's a spot transaction? A transaction which is settled after 2 business days from the trade date. The trade date is the date that we come to the agreement, and the settlement date is the date on which we transfer funds and or exchange the ownership. On which we settle the transaction. We call it as trade date or value date. So when the value date or the settlement date falls after 2 business days from the trade date, we call it a spot transaction. That's the norm in the market, wholesale market. But there are some other standard settlements as well, like TOM or cash. What does it mean by TOM? A transaction which is settled after 1 business days from the trade date. Cash settlement is referred to a transaction which is settled on the same date as the trade date. That means trade date and the settlement date are the same on a cash transaction. What is a forward transaction? A forward
settlement in future.
Yes.
Settlement in the future.
What do you mean by future? That's the important thing.
Suppose say
it has to be beyond spot.
More than 2 days.
More than 2 days.
more than
2 days even in our general world, future means even tomorrow is future, but in this FX market, tomorrow is not future. It's like in the history, because spot date is the normal settlement date. Tomorrow is we are coming back from spot. But future is going beyond the spot date in the foreign exchange market. So forward transactions are settled on a day after the spot date, but there's no limit for that. Anything beyond spot date. So that's the forward transaction. Then we discuss how to. Oh no, we discussed then what are the risks in the foreign exchange market. We discuss translation risk, transaction risk, and economic risk. Then how to use forward contracts to hedge our exposure. We discuss these things. If you have a long position, to hedge that, what you should do in the forward market. If you are receiving foreign currency, or you have some agreement to sell something and or to export something, and once you fulfill that requirement, you will get foreign currency, say in 2 weeks time. What is the risk that you face, and how do you hedge it in foreign exchange forward? Since you are receiving foreign currency, the risk is if value of foreign currency decreases in terms of local currency. So you are receiving foreign currency. That means you have an asset. In other words, you are having a long position. What is your requirement? Your requirement is to sell foreign currency. So therefore, to hedge that, what do you do in the forward market? You sell foreign currency in the forward market. So when you have a long position, what do? You sell forward. When you have a short position, what do? You buy forward. That means you enter into a transaction to buy foreign currency on a future date. But the rate, currency pair, the settlement date, everything is agreed today. So based on the terms agreed, you settle the transaction on the settlement date, irrespective of the market price or the market exchange rate. You have to settle the forward transaction at the agreed price. So that's the brief that what we discussed last week. What we couldn't discuss last week is the last part of this presentation. That's how to calculate the forward forward rate. That's what we have to discuss today. So we discussed this to hedge how to hedge using forward contract. Basically, if you have a long position, you sell forward. If you have a short position, you buy forward. And the other thing is, as given in this slide, in the market there may be standard settlement dates. Say 1 week, 1 month, 3 months, likewise. But if you need in between those settlement dates, you want to settle a transaction in between these dates, it's possible. There's no barrier in the forward market. Both parties can agree to any settlement date, but it has to be a working day or the business days in both financial centers. If it is a business day in both financial center, any day can be selected as a settlement date. But in the market, sometimes for easy reference, we use 1 week forward, 1 month forward, or 6 month forward. Then in that type of transaction, standard settlement, when we say 1 week or 1 month from today, how do you settle or how do you decide the settlement date? That is important. You should know that. It will always fall on the calendar date of the following month, corresponding calendar date of the following month. So remember, in this example, given example, I'll take it that as an example. It is easy. If the spot date is 24th September, then the 1 month forward would be on 24th October, assuming 24th October is a business day, not a holiday in none of the financial centers involved in this transaction. So if it is a dollar-rupee transaction, 24th October shouldn't be a holiday in Sri Lanka, nor in US. So US and Sri Lanka both working days. 24th October is a working day for both US and Sri Lanka. And remember, 24th September is the spot date. But when do you enter into this agreement? It's not 24th September. Assuming no holidays, 22nd September is the trade date. We enter into this agreement 1 month forward contract on 22nd September. Then the settlement date falls in the next month on the corresponding date to the spot date. So if you do the transaction on 22nd September, spot date would be 24th September. Since it's a 1 month forward, we move forward 1 month from 24th September. Then it falls on the corresponding date in the next month, 24th October. So that's the general rule, but there are few exceptions. Assume you did a transaction on a month end, say 31st October. 31st October is the spot date. If you do a 1 month forward, what would be the settlement date? The spot date is 31st October. Then the settlement date should be, if you take the corresponding date, it should be 31st November. There's no 31st in November. In that case, we take the last business day of the month. If the corresponding spot date is the last business day of the month, last day of the month, then the settlement will fall on to the last business day of the next month. Or if it is 6 month, 6 month time. That's the rule. Then the next thing is, assume in this example, November 30th is a holiday. What do you do? No. In that case, we don't go switch it to December. We come back. We take 29th November as the settlement date. If 30th November is a holiday, it's the last day of the month. So we don't move the settlement date forward. Instead, we move it backward. So therefore, we select 29th November as the settlement date. But assuming this example on the slide, 24th October should be the settlement date. Assume 24th October is a holiday in one of the financial centers. Then how do we decide the settlement date? 24th September is the spot date. Then corresponding 1 month date is 24th October, but it's a holiday. So then in that case, we don't come back. We move forward. So in that case, 25th October would be the settlement date. So that's how we select settlement date for this standard settlement, 1 month, 6 months, 3 months kind of things. But there's no rule to be adhered into those things. Without saying 1 month, if you want, say you want to enter into a trade on 22nd September, the corresponding spot date is 24th September, but you want to settle this transaction on 22nd October. You can do that. What you have to do, agree with the other party. Since this is over-the-counter transaction, OTC transactions, you know that everything is customizable. Sorry, you didn't tell me that the presentation is not shared with you. Now you can see it on the screen. So we were discussing on how to decide the settlement date for standard settlements like 1 month, 6 months, 3 months, 6 months kind of settlements, but it's not necessary since these are over-the-counter transactions. You can decide whatever the settlement date that you want, but only thing is that settlement date should be a business day on both financial centers. So now we'll move into forward rate calculation. Basically, the forward rate is calculated as the future value of the counter currency divided by the future value of the base currency. What does it mean? I'll explain that. This is the equation to do that. If you can remember this equation, it's okay, but get the idea what is behind this equation. So first I'll explain the equation. F stands for the forward rate, S is the spot rate, then R, D, interest rate for the counter currency. Interest rate for the counter currency. RF is the interest rate for the base currency. RD is the interest rate for the counter currency. RF is the interest rate for the base currency. Then what is this D? D is the number of days between spot date to the future or the futures settlement date. So in this previous example, 24th September to 24th October, how many days? How many days there will be in between 20?
1 month.
So, sorry?
1 month.
How many days? If I ask how many days per month?
So, 30 days?
In this example, yes, 30 days. But assume, what would it be if it was 24th October to 24th November?
31 days.
31 days. So likewise, you have to count exact number of days in between the spot date and the your settlement date. So D is that. Then this 360, for simplicity, I have used 360 in both numerator and the denominator, but that depends on the number of or the market convention. If I ask how many days in per year, what's your answer?
So general 365 days.
365.
Yeah.
So how many days that we use for a 1 year treasury bill in Sri Lanka?
364.
364. So in financial markets, there's no fixed number of days per year. It's not 365, it's not 364, that depends. That depends on the market. Even in Sri Lanka, bond market, we consider there are 365 days per year, but in the bill market, we consider only 364 days. So there are markets, they assume there's only 360 days per year, and they assume every month there are 30 days. So even February, they assume if it is 1 month, they assume there are 30 days. So depending on that convention, whether you use here 360 or 365 or 364 varies. But in the international market, most of the money market instruments are traded on the 360-day count basis. So that's why I used 360 here. So the next equation, that is an approximation of this equation. Instead of doing this difference, what you can do, or instead of this division, when the interest rate are very small, we can just use the difference of the interest rates. Interest rate of the counter currency minus the interest rate of the base currency, and multiplied by this factor d over 360. Why the 100 is there? Remember, if the rate is 5%, if you just put 5 here, it has to be divided by 100 to make it a percentage. That's why the 100 is there. But if you use in decimal forms, instead 5%, if you write it as 0.05, then you need not to use this 100 in either case. This is an example. Assume Euro USD spot rate is 1.4045 and the 6-month LIBOR, and assume this is a 6-month forward. We are going to calculate 6-month forward rate. So the 6-month LIBOR rate is 0.46%, and euros for LIBOR for Euro 6 month is 1.45%. Then what do we have to do? First thing, we have to identify what is the base currency. Then we have to identify what is the counter currency. What's the base currency here in Euro USD pair?
Euro is the base currency.
Euro is the base currency. This is the base currency. So the price of 1 euro is given in terms of dollars. So euro is the base currency, dollar is the counter currency. Then in our equation, what is this? This is RD, or you might call it RC. That means interest rate of the counter currency. Then what is this? That is the interest rate of the base currency, or as given in the equation, interest rate of the foreign currency. So whenever you do this type of exercise, remember, first identify these things, then write the equation without substituting any number, just write the equation. Then only you will remember the equation. Write the equation, then substitute. So in Euro USD pair, we assume 360 day count convention. Therefore, for 6 months, there are 180 days. And 360 days per year. Spot rate is 1.05. It's written here. Then the interest rate for the counter currency 0.46, and the interest rate for the base currency is 1.45. So when you simplify this, you get 1.3976. The answer is 1.3976. Be careful when you use the calculators to do this. Different calculators perform these brackets and multiplication things in different manner. So you should know what is the order that you have to key these numbers to get the correct answer. If you key it in the incorrect manner or incorrect order, still you will get an answer, but it may not be the correct answer. So therefore, better you study your calculator first, how to key these correctly. Now, in this example, you can see spot rate is 1.4045, forward rate is 1.3976. The forward rate is smaller than the spot rate. What does it mean? If you are to buy euro against dollar today, you have to pay $1.4045 per euro. But if you postpone it for 6 months, you have to pay only 1.3976. Why is that? But okay, before we discuss what's the reason, if you go back, or if you think about the Sri Lankan context, this would be other way around. In Sri Lankan context, forward rate would be higher than the spot rate. But I think 2 weeks ago, there were a few days, or at least one day, even in Sri Lankan market moves into this direction for some reasons. Okay, what is the reason here? When the forward rate would be lower than spot rate, and on what condition the forward rate would be higher than spot rate? What do you think? What are the factors that drives this relationship? It is
interest rate differential between currencies.
exactly. It is the current interest rate differential between two currencies. When you calculate the forward rate, whatever the interest rate differential, that matters, nothing else. So therefore, you cannot predict that in 6 months time, euro dollar exchange rate will go down to 1.3976. It's not the interpretation. It's not correct. This is not what market expect in 6 months time. This is purely because of these two interest rates. Here you can see interest rate of the counter currency is lower than, RC is lower than are weak. Interest rate of counter currency is less than interest rate of the base currency. So high interest rate is in the denominator. So this figure, you can see above the line part and the below the line. The only difference is these two interest rates. So we are going to divide two figures. Which one is high? The number in the this is high because 1.45 is higher than 0.46. So we are going to divide two numbers, but small number divided by a large number. Then what do you get? You get a number less than 1. When you divide a small number by a large number, you get a figure less than 1. So in total, this will give you a less than 1 number, point something. So when you multiply this figure by less than 1, you get a lower number. That's why in this example, forward rate is smaller than the spot rate. So we'll do an example in the Excel. So let's say USD LKR 3 months forward, spot, we'll put 190, easy. US dollar interest rate 3 months, okay, 0.25. LKR interest rates for 3 months, 3%. What is the 3 months forward rate? Spot rate into 1 plus, assume 3360, it's easy again. 3 months, there are only, sorry, first thing, the interest rate. What is the base currency here? What is the counter currency here? In the dollar rupee,
USD base.
dollar is base, LKR is counter currency. So what is the interest rate that we have to put here? Is the rupee interest rate and multiplied by 90 divided by 360 into 100 divided by 1 plus US interest rate, again 90 divided by 360 into 100. Better we put a bracket there as well. Do you expect a higher number or higher than 190 or less than 190? What do you expect?
Higher number.
Higher number. Why? But it can't be this much. You expect a higher number because rupee interest rate is higher than the dollar interest rate.
Answer should be 191.30 or 31.
191.3054.
1.3054.
3054. I'm trying to identify what's from here. Okay, we go like this. Plus 3 into 90 divided by Is it correct? Okay, it's somewhere 191. What's the answer that you told me? It's different from this.
Yeah, it's 191.3054. The one I got.
191.3.
3054.
Let's check first this whether this fraction you get this. Okay, however, what I wanted to highlight is depending on the interest rates, if the counter currency, this is our counter currency and base currency, depending on the interest relationship between two interest rates, whether your forward rate is higher than spot or forward rate is lower than spot would be decided. And remember, it's not an interpretation or a forecast for the future exchange rate. You cannot consider it as a forecast. Is it clear? Then I want to explain what is this. In the definition, I said it's the future value of the counter currency divided by the future value of the base currency. What do we do here in this calculation? What is this? this part. Assume we have a $1 and we invest it for a 6 month. What is the interest that we get? How do you calculate it? I have $1. I will invest it. I'm going to invest it in a deposit or money market product. The interest rate that I will get is 0.46%. So what's the amount I will get at the end of 6 month period? That's it. This is the amount I'm going to receive in 6 month period. Clear? This is simple interest calculation in the money market. Then what is in this? This is the same thing for €1. If you invest €1 for a 6 month period at 1.45, what is the amount you are going to get? This is the amount. Clear? So we calculate future value of today's value. But then what would we get when we multiply these two together? Spot rate and this compound. What is the interpretation of this spot rate is €1 equals €1 equals $1.4045. So what do? We invest this $1 for a 6 month period. Sorry, €1 for a 6 month period. This is the amount that we are going to get. And if we invest this, the equivalent amount in dollars, that means $1.4045 for a 6 month. This is the amount that we are going to get. If today €1 equals to $1.4045, we assume even in 6 months it has to be, whatever we get has to be equal each other. So whatever the forward rate coming from this should be equal to whatever the forward future value of this. So then it won't be, this side won't be 1. So to make it equal 1, this side won't be equal to 1. It could be more than 1 because the interest rate is positive. It would be more than 1. This is also more than 1. This side also. To make, once you make them equal, so it would be something like 1.004 euros equals 1.003, something like that, dollars. Then we want to find the value of €1. What do? We divide both sides by this figure. That's what happened in this equation. That is the concept behind in that. Is it clear? Let me explain it on the board. You can see the board.
Yes.
Yes. Okay. Can you remember the numbers? You can tell me. Spot rate is 1.4045. This is for Euro USD. Can you see? Can you see the board?
No, sir.
No.
No.
Oh,
One side is missing.
sorry?
One side is not visible.
One side is not visible. Which side?
104.
Here. If I write somewhere here,
Yeah, that's okay.
it's okay. This side. Is it okay if I write this side from the
That's
line?
clear. Okay.
Okay, fine. So Euro USD, the top you can see 1.4045. What does it mean? 1 euro equals 1.4045 dollars. If I invest this $1, 1 euro for a, in that example, it's for a 1 month, 6 month period. What was the rate? 0.46%. Is it correct? No, this is dollar rate. Yes, $0.46, euro 1.45. And I invest this dollars for 6 months at 1.45. Euro at 1.45%, dollar at 0.46%. Correct? These are the numbers given. 6 month interest rate for euro is 1.45. For dollars is 1.46%. You invest 1 euro for a 6 month and 1.45. What's the amount you get at the end? 1 plus 1.45 into 180 days divided by 100 into 360. This is the amount that you are going to receive. On the dollar side, 1.4045, because that's the amount that we invested for a 1 month period. What's the amount that we are going to receive? 0.46 into 180 days divided by 100 into 3. So 1 euro equals 1.4045 dollars. So in the forward market, we assume even after 6 months, whatever the future value should be equal to each other. So this is the future value of 1 euro today in 6 months. This is the future value of 1.4045 dollars in 6 months time. So it should be equal to each other. Then this is euro amount, this is dollar. So what's the value of 1 euro then? What do you do? This is more than 1. We take this part to the right hand side, then we'll get price for €1 as this is the equation. Oh, this is the answer in that slide. When you solve this, you get 1.39 something. I cannot remember the number. 3976. So this is the concept behind that equation, how to calculate forward rate. Is it clear? So either you can remember the equation or remember this concept. Better to remember this concept because you won't forget anything. If you try to memorize that equation, you may forget what is in the numerator, what is in the denominator. If you change those things, you will get completely wrong answer. Only thing is, check your answer. How do you check your answer? You can't say exactly this, whether it's correct or not, but at least you can check the direction. How? Compare these two interest rates. Hope now you can see the presentation. Can you see the presentation?
Yes.
No, still not.
Yes, still not. Now?
Oh, okay.
Oh, now okay, okay. How do you check whether your forward rate calculation is correct or wrong? The relationship we discussed earlier. If RC, counter currency interest rate, is less than the foreign currency or the base currency interest rate, I'll put it as base currency. This is the best, I think. Best way to remember it as counter currency and base currency other than foreign and domestic. If this is the case, what is the relationship between F and S, forward rate and spot rate? Counter currency interest rate is lower than the base currency. Then what is the relationship between forward rate and the spot rate? It's almost like in this example, dollar is the counter currency, interest rate is lower than the base currency interest rate. So the forward rate is smaller than the spot rate. So whenever you do a calculation, just check at least you get this relationship. A forward rate less than spot rate. Even that one may be wrong, but at least you have got the direction correct. But if counter currency interest rate is greater than the base currency interest rate, then you should get higher forward rate than the spot rate. Clear? Then in these two markets, we call them, in this market, when the forward rate is less than the spot rate, we said base currency is at a discount.
Discount.
In the second scenario, when the counter currency interest rate is higher than base currency interest rate, we get the forward rate higher than the spot rate. In this scenario, we call base currency is at a premium. To buy forward, we have to pay more when there's a premium. When there's a discount, to buy the foreign base currency, you have to pay less. So at that scenario, base currency is at a discount. So just remember those as well, because in the market, you will use those jargon. Forward would be at a premium or a discount. In Sri Lanka, we call forward is at a premium. Why? Dollar is trading at a premium. To buy forward or even to sell forward, you get higher forward rate. So that's how we calculate the forward exchange rate. Then there's another terminology called swap points. The swap points are the difference between forward rate and the spot rate. In the previous example, forward points are minus 0.0069 because forward rate is smaller than spot rate. When you subtract spot rate from the forward rate, you get a negative figure. You get minus, I'll put it here, minus 0.0069. But in the market, they won't call it 0.0069. They just say 69 points. It should be 69 points or pips. Either way. So that's the chart. What is swap points? Swap points is the difference between forward rate and the spot rate. Exactly speaking, forward rate minus spot rate. When you say the difference between this and that, you know what you subtract from which. So in this case, spot rate is subtracted from forward rate to calculate the swap points. So again, the same thing as mentioned earlier. If the swap points are positive, then we say the base currency is at a premium. If the swap points are positive, the base currency is at a premium. If the swap points are negative, then we say the base currency is at a discount. But you know, when you get positive swap points, when do you get positive swap points? When counter currency interest rate is higher than base currency interest rate. When this relationship exceeds, F is greater than S, then F minus is greater than 0 or positive. Then you get a positive swap points. Then the base currency is at a premium. When the relationship get reversed, you get the reverse answer. Just remember those things. The same thing what I've explained. If counter currency interest rate is greater than base currency, then the base currency is at a premium. So there's a relationship. Two interest rates, the relationship between two interest rate and the relationship between forward and spot, and whether swap points are positive or negative, and whether base currency is at a premium or discount. So that's how it works. Use of forward FX we discussed last week, how to do that. To hedge, you can use in two different ways. If your position, that depend on your position. If you have a long position or if you have a short position, what do you do? If you have a long position, what do you do in the forward? You have a long position to hedge, then you sell in the forward market. You have a short position, then you buy in the forward market. What does it mean? You enter into a transaction to buy base currency. In this case, you enter into a transaction to sell base currency on a forward basis. That's how we use forward foreign exchange to hedge your exposure. Any question? So now I'm going to move into swaps. Before we move into swaps, we have to be clear on the forward market. Do you have any question? If you don't have any question, I'll move forward. I'll explain briefly what's a FX swap transaction. In simple terms, this is a combination of spot and forward. Or it can be, I'll make it short, can be a forward as well. So FX swap is a combination of two trades. Most of the time it would be spot transaction plus a forward transaction, but it can be two forward transactions. But again, like in a forward contract, you enter into both this spot and forward transaction at the same time, but we consider it as a single transaction. The spot and the forward transaction, both we consider it as a single package and we consider it as a one transaction. So what do you do there? Let's consider this spot and forward transaction. Either you can do, say you buy foreign currency here on the spot basis. If you have bought spot, then what do? You sell in the forward. So you come to an agreement with another party to buy foreign currency on spot basis and sell the same amount of foreign currency on a forward basis. You enter into an agreement on the same day, same time. Simultaneously you do this. Then we call it as a FX swap. So this is we call buy sell swap, because in the spot leg you buy foreign currency, in the forward leg you sell foreign currency. But you can do the opposite as well, sell and buy. What do you do in that? In the spot market you sell foreign currency, and in the forward market you buy foreign currency. But remember, same amount. The amount that you sold, you have to bought in the future in a sell buy transaction. If it is a buy sell transaction, whatever the amount you bought, you have to sell it in the forward market. So this transaction is called FX swap. So two types of FX swap: buy sell or sell buy. That depends on what you do in the near leg and the far leg. The spot transaction, we call this as near leg. Whatever you do first, it is near leg. And the forward leg, we call it as a far leg, or the future leg, or sometimes we call this as first leg, and this is as the second leg, far leg as the second leg, which comes first and second. So that's a forward, sorry, that's the swap. So depending on the interest rate differentials, again, as we discussed in the forward market, parties may receive the premium or receive the discount or pay the premium, depending on whether you do a buy sell or a sell buy. So the important thing is, when you do FX swap, it doesn't create any exposure. Why? The moment you buy, you have entered into a sell transaction as well. So you have the asset as well as the liability in the same amount. So that will be set off each other. In the sell buy transaction, you create a liability. Meantime, you create an asset as well. So there's no exposure to the market. Whatever the foreign exchange rate move, you won't get any profit or loss. That's the key feature in FX swaps. Do not create an FX exposure. So therefore, when you don't have any exposure, that means you are hedged. You cannot make profit, or you cannot make losses. Whatever the exchange rate moves, you don't make profit or loss. That's the interesting thing. But when are we going to use it? And remember, you cannot make profit or loss because of exchange rate changes, not for anything else. You cannot make a profit or loss due to exchange rate changes. There may be some other ways that you can make profit or loss using a FX swap transaction. So one way of use of FX swap is to cover mismatch of cash flows. I put the cash flow as well here. Say today, t equals 0, t equals 2, that means after 2 days, and assume this is after 7 days. I'll make it 9. From here to here only 7 days. Assume you have a foreign currency inflow here. You have an outflow here. Same amount. What you can do, and this is foreign currency, but in local currency you need an outflow here. You have outflow here. You have inflow here in local currency. There's a cash flow mismatch here. You receive dollars, but you need rupees. In 9 days time, you need dollars, but you receive rupees from different transactions or contracts. How do you cover this mismatch? You can sell whatever foreign currency inflow here in the spot market at this date. You can enter into that transaction to settle the foreign currency on spot basis. So you convert that foreign currency inflow, by selling that foreign currency to a inflow of local currency. Then you can use that rupee flow to match your outflow. By doing that, what's the exposure that you get? You have a dollar outflow here in future. You have a rupee inflow as well. You can use this inflow to buy this foreign currency. But what would happen? The exchange rate might have moved against you. You may make a loss. So therefore, without waiting for this date, when you enter into a sell transaction here on the spot date, simultaneously you can enter into another transaction to buy it back on the forward to match this outflow. You don't have to worry about it because you have a rupee inflow as well. So whatever your inflow that you are receiving today in foreign currency, you convert it into rupees and use it to pay back your dues today. But to make sure that you get the foreign currency back for the future requirement, and you have a rupee inflow as well, you can buy it back on the spot basis. Sorry, on the forward basis.
So can you explain that in the board, please?
Sorry?
Can you explain that on the board?
Oh, sure. Now you can see the board. Yes?
Yes.
Which color you prefer? Which black, red, or blue? Which one is visible for you?
Red.
Red. You can see this. Okay. Forget about the spot concept today. Today you have inflow of USD 1 million. And meantime, say after 1 week time, you have outflow of USD 1 million. If you have only these two transactions, what you would do? Assume you have only these two transactions. What you would do? You just receive this 1 million and maybe invest for a 1 week period, get the maturity proceed, pay back this 1 million in 1 week time, isn't it? That's very straightforward. But assume you have an outflow of LKR today, say 190 million. Assuming spot is USD LKR 190. So you have an outflow of 190 million, but you have the inflow in dollars. There's a cash flow mismatch here. What you can do, now you cannot keep this $1 million for a 1 week period to meet this liability, because before you meet liabilities in 1 week time, what you have to do? You have to meet the liabilities which are due today. So you have to meet this liability. So you have to sell this USD 1 million to generate this 190 million rupees. The moment you sell this foreign currency inflow, now you are exposed to foreign exchange rate risk. Why? 1 week time you need $1 million back. You can wait until a week time and buy it back. But at that time, if the exchange rate is 192, you have to pay more rupees to buy that. What you can do, you need somehow rupee inflow here. When you enter into this sell transaction to sell it spot basis, meantime you enter into a spot forward transaction to buy USD 1 million. So enter into a sell $1 million and to buy $1 million in forward. So instead of doing two separate transactions, these two, you combine them and do it as a sell by swap. You do it as a sell by swap. You sell foreign currency on spot basis and buy foreign currency on forward basis. Clear? Is it clear? So you can use this swap transaction to avoid your cash flow mismatches. If you have in outflows here first, then what do you do? Instead of inflow, you have a outflow of dollars here and inflow of dollars here. Now again, if this inflow and outflow happen on the same date, you could have matched them. No exchange rate risk. But here, your outflow comes first, then or before the inflow. Then how do you match this? To meet this outflow, what you have to do? You have to buy. Whenever you get this inflow, you have to sell. So the best thing is to do is enter into a buy sell. So then you eliminate your exchange rate risk. You buy foreign currency today, meantime you enter into a transaction to sell foreign currency on a forward date. So this is effectively you use whatever inflow here to pay the outflow here.
So, but sir, small concern.
Yes.
Now, let's say now we have two options. No, one is this hedging, and the other one is we can go for finance short-term liquidity financing. No, I mean short-term requirements we can finance from local banks as well. So then again, that will depend on the rate, is it? I mean, now let's say if we can, if the banks offer a lesser rate, where we have the advantage over the interest rate, we can use that option as well. No.
Yes.
So that will also influence this. No.
This depends on the premium as well. Whether you go for a over transaction or not depends on the premium. Say, in this example, you buy here, you sell here. Okay, today's spot is 190. However, you have to buy or at least to borrow dollars for a 1 week time. So assume you are trying to buy spot is 190. Okay, and assume 1 week forward is 190.05. $190.05. So will you go for this swap or not? How do you decide it? In simply, you can see to buy you pay only 190, but if you sell it in the forward market, you get 190.05. You have a 5-cent advantage in one way. But what is the risk in this scenario? If the exchange rate goes down 189.90 or something like that, because you are about to sell foreign currency in the future. That's what you have to think. So when you look at this, you feel it's better to go for this because you pay only 190 today to buy dollars. You can sell at 190.05, so you have a 5-cent advantage. But it's not the only concern. To buy dollars, today what do you need? You need rupees. What is your rupee cost? If you can invest it here for more than, to get more than 5 cents, then that's a different story. Financing this by using this rupee, it would be possible. Or as you said, other option is directly borrow dollars. What is your cost there? So there may be more than one option. You have to evaluate each and every option available and select the best one. That's true. Clear? As you said, yes, you can finance, go for a short-term finance for a to borrow dollars. Then you have to consider what is the cost of borrowing in dollars, and what if you do the swap transaction, or if you finance this position in rupees, because you can borrow rupees and use that rupees to buy dollars and meet this output. Then you borrow rupees for 1 week time. What is the interest that you have to pay here? And whatever the dollar inflow comes here, you can sell that dollars in the spot market and meet the rupee liability. That's another option that you have. So you have to evaluate all these options and calculate the cost and go for the best. I'm not saying the best thing to do a sell buy. So this is only one of the options. So as I mentioned, not sure whether I told to you, there's no free lunch in financial markets. It's a very famous saying that there's no free lunch. Whatever the transaction do, there's a cost. So what you have to do, select the lowest cost path, even though you say it's the cheapest, there may be hidden costs that you have to identify properly. Anything else?
Yeah, how to determine the forward premiums?
That's based on the
Interest rate.
equation that we discussed.
That being interest rate.
Yes, yes. You know the spot rate, you know the two interest rates, then you can calculate the forward rate. The difference is the premium or the discount, and whether you pay or receive. That depends on what do you want to do, buy, sell, or a sell, buy. So now can you see the presentation now? Can you see the presentation now?
You can see.
Yeah. Any other question? And the last point, bullet point here, so is related to the question that you asked. How do we calculate the premium or the discount? That depends on the interest rates differential. So therefore, in swap transaction, the way how you make a profit or loss is depending on the interest rate movement. That means when the interest rate moves, our swap points are moved. So that volatility gives you the profit or loss. So therefore, even though the FX swap is we call it a foreign exchange swap, we can use it to hedge the foreign exchange exposure. But the profit or loss profitability, if you want to trade the FX swaps, it has to be as a interest rate product. So based on the interest rate variation only, we can make a profit or make or loss. If interest rate, say you enter into a 1 month swap, if the interest rate changes tomorrow, then the 1 month swap points would be different from what you trade today. So based on that, you make a profit or loss. So therefore, effectively, effects of swap points can be used to trade interest rate volatilities in relatively. That's the other important thing. Say dollar rupee swap points, if both rates are going up at the same amount, oh, there may not be a change in the swap points. But if one rate goes up than the other one, then there will be a change in swap points. So relatively, how these changes, that matters into the swap points. So that volatility can be traded through FX swaps. That's how market operates in the swap market. So in the next few slides is just yes, discuss this one. So this is an example of a swap price and how do you trade. If you ask for a price for FX swap, they just quote the swap points, not the two exchange rates, just the swap points, because in swap market, swap points are the variables that matters. So in this example for Euro Australian dollar 6 month 248 255 swap points are quoted. So what does it mean? So whatever the exchange rate today, the spot rate, the market maker would like to add 248 points to the bid and 255 points to the offer. The market maker will add 248 points to the bid and 255 points for the offer. So if I go back to the board, I think it's better. So points are 248 and 255. I have a doubt whether you can see this. In the stock markets, to adjust the or calculate the forward rate, basically we use the mid rate. Say that was on Euro AUD. Yes, Euro AUD. Is this one? Assume Euro AUD rate is say something like that, 1.6975. 1 euro equals 1.6975 Australian dollars, and these are the forward points. What is the forward bid and what's the forward offer? Remember, this is in points or the pips. So therefore, you remember in the previous example, 0.0069, we call it as 69 points. Then in this example, when we say 248 points, how many decimal points are there? And what is the decimal form of this 248? It is 0.0248. And this one 0.0255. To derive the forward bit rate, what do we have to do? We have to add that forward point in the bid side to the exchange rate 248, and to the offer side 697 plus 0.025. $1.7223 is the bid rate. Offer rate 1.7130. Still you can see bid is higher than, sorry, bid is lower than the bid. 1.7230. So bid is lower than the offer. That has to be maintained. Whatever. So now see, whenever you do this sort of calculation, just check. I realized that something wrong because of that. The bid should be lower than the offer rate. In my previous answer, it was not the case. So I double checked. So that's what I asked. When you do this sort of calculation, when you get that answers, just cross check whether the answer follows the fundamentals, the basics. So this is how we calculate the forward rates based on the given SOP points.
So one clarification.
Yes.
So here we have taken Euro AUD spot rate for only for the bid, and we have ignored
No,
the offer rate.
No.
Why?
In the stock markets, what would happen? They just take the mid rate and do the adjustment. Not the bid spot and offer spot. They don't take two rates. Just take the mid rate and do the adjustment for the bid and offer on the forward market. That's why I just took only one rate. Is it clear? This is not the bid rate. 1.6975 is not the bid. It's the mid. Clear?
Okay.
Okay. So then based on that, you will, based on these codes, you will get the forward trades. But however, what does it mean? If you, okay, as a market maker, what he is agreeing, so if he sells today, he has to buy it back on the future date. So when he buy back, he has to add these swap points. So he add the lesser number of swap points. So that is the amount he is agreeing to pay. So this 248 points is the points that he agrees to pay to buy forward. And meantime, if he want to sell forward, he wants to receive 255 basis or 255 points. So as a market maker in a sell and buy euro, he is willing to pay 248 and he is willing to buy he is willing to receive 255. But from the market maker's point of view, assume he agrees to do a trade on 255. What does it mean? He agrees to sell today and buy future paying at 255. So market taker will pay 255 points. So the market maker pays the premium of 255. If the market taker pays the premium of 255. If market taker agrees on 248, what does it mean? Market taker agrees to receive a premium of 248. Why he is doing that? Now he's in this example, if the taker decides deal at 255, that means he is agreeing to pay 255 basis points. What does it mean? That he agrees to pay 255 points for the futures transaction. Why? He thinks 255 points is small. Interest rate on OC may go up than the euro, and this 250 basis points will go up. 255 points will go up. So he is thinking paying 255 is cheap now, and he's expecting that to go up. That's how they do trades on the swaps. So that is something that you have to consider even you are going to do a swap to hedge. In this, you are mostly concentrate on the risk side, how to hedge risk. That's the way that you do. You have to think about whether paying or receiving these points is enough or not, or cheap or expensive. Not only that, if your traders are trading swaps, then you should identify what does it mean and what are the risks arising from this. What is the risk in this transaction? Assume this trader, market taker, decides to deal at 255. What is the risk? If this swap points gets lower in the future, the trader makes a loss. If this 255 goes down to 250, the trader makes a 5 points loss. So to manage that risk, you should know that the risk is there. And we discuss FX swaps here, and what are the uses of FX swaps. You can use it for funding purposes, as I mentioned earlier, or as a interest rate risk mitigation. Whether you borrow in dollars and lend it rupees, things like that, you can mitigate that risk using a swap, or you can use to trade the interest rate differentials in two currencies. And the last one is covered interest rate arbitrage. That one I didn't discuss here. I think it's too much if you have to discuss that, because even in the swap forward forwards, you might see uses of forwards, arbitrage is there. I didn't discuss this arbitrage. What does it mean by arbitrage and how to identify whether there's an arbitrage and how to trade that. So don't worry about this arbitrage. But up to now, first thing on FX transaction, you should be able to identify what is the exact risk that you have. Don't say by doing this you have FX risk. It's not sufficient. What is the exact risk? Whether the foreign currency appreciation or a depreciation. To identify that, you should know your position correctly, whether you have a long position or a short position. Based on that, whether you have a long position or short position, what is the exact exchange rate risk, whether currency appreciation or depreciation, and whether that risk is generated through a translation or the transaction, or it's economic risk that you should be able to identify. Then how to price a forward contract, how to price a swap, both are the same, because second leg of the swap is the forward contract. The same forward contract is used. There's no difference. How to price forward and swaps. Then how to use forward contracts to hedge your existing FX position. And how to use FX swaps to mitigate your or hedge your cash flows, difference in cash flows. I'm not expecting to evaluate to different options to hedge that available for you to take action and select the best, but you should be able to explain how are you going to use FX swap to hedge your foreign exchange exposures, to compare it with other options and come to a conclusion. I'm not expecting here, because I didn't discuss that at a sufficient level. I just mentioned it because there may be two more alternatives and you should be able to select it. But before that, first you should know how to use each and every product to hedge this. So that's what our concern here. So that's the basic of what we discussed so far. We will take a break here, but before we take a break here, if you think you have any question, you need more clarification, please raise now. After the break, we'll move into the other presentation on the risk in foreign exchange transactions too. It's on how to use basically options. I'll mostly concentrate on options, not on forwards, because, sorry, futures, because it's not that much use in Sri Lanka, or not that much. We don't have futures market. So we'll discuss how to use options in foreign exchange market, how to hedge your foreign exchange exposures with options, and what are the advantages of having options than over the forwards. That comparison you should be able to do at the end. When to select forward and when to select option, and what are the pros and cons. Once we discuss this, you should be able to do that. Okay. Any question? If you don't have any questions, we'll take a break about 15 minutes. Is it okay? Or you have any questions? After the break, we are going to discuss options. I'll briefly explain what are the options, different type of options, and how to hedge it. But unfortunately, we have you discussed derivative products? Have you discussed derivative products?
Not yet.
Not yet, no. Unfortunately, yes. But I'll explain options briefly, but you will get to know when you discuss derivatives thoroughly. But get the basic here and how to use it in to hedge FX risk. Okay, if you don't have any questions, we'll stop here. Or not stop, we'll take a break for about 15 minutes. Can you hear me?
Yes.
Yes, okay. So any questions again before I move into this? Any questions? No. So I'll straight away explain you options and how to use options with this limited time, because today I have to finish this. Next week onwards, I think Mr. Karunaratna will take over the class and move ahead with the other topics. So I have to finish this today. I'll straight away jump into options. You can see the board, not the presentation. No? Can you see the board?
No, not yet.
Not yet. So now,
Okay, thank you.
okay, thanks. So options. What's an option? So as the word, the option implies the buyer. This is fine. Again, derivative product that can be buy or sell, that can be bought or sold in the market depending on the circumstances. So whoever the buyer gets a right. So that's the basic concept option, which the buyer of the option gets a right. What is the right? We'll discuss later, but to take some action, he has some right. And not only that, even in a forward contract, if you buy forward or even you sell forward, you have a right. What is that? To sell foreign exchange or to buy foreign exchange on that specified date. Not only that, in that sort of transaction, the buyer or the seller has the obligation as well. But in options, buyer gets a right, but no obligation. That's the key. Buyer has a right, but no obligation. Let me explain that. You buy some insurance. Say, okay, the best one would be, say, automobile insurance. You insure your vehicle. To buy that insurance, what do? You pay a small, or depending on the valuation, you pay a premium to the insurance company. Okay, and for some reason, unfortunately, you met an accident. There's a damage in your car. Will the insurance company come and say to you, see, now your vehicle is damaged. You have to make the claim from our company and we'll pay you the damage. Would that happen? Will they come and enforce you to make the claim? It won't happen. You have to inform them. See, I have met an accident. There's a damage to my vehicle. So pay me the damage to repair it. Then they will try to not to give it. However, depending on the condition, that's a different story. However, if you decide not to call the insurance company and not to claim anything, will there be any action against you? No, insurance company, it won't mind about your action, whether you make the claim or not. If you make the claim only, they will see whether you have met all the conditions. If yes, they'll pay you the damage. The option of whether to claim that or not is with the insurance buyer, not with the insurance company. And you don't have any obligation other than paying that premium. You don't have any other obligation when something goes wrong. Similarly here, in an option there may be some criteria defined. If those criteria are met, the option buyer can decide whether to exercise that right or not. There's no obligation. The other party cannot say, see, you have to do this. No. But if the buyer asks, I want to do this, then the option seller, the other party, has to meet that obligation. That's the basic. So remember, in an option transaction, option buyer gets a right, but no obligation. Clear? Is it clear? Then, what is this right? This right can be either to buy something, we call it by the underlying, or sell the underlying. The right can be either to buy the underlying or either to sell the underlying. What does it mean here, underlying? Say in this example, or in this, since we are discussing about foreign exchange, say USD pair, this is the currency pair. So here, the right the buyer of the option would get is to either to buy dollars or if you need the right to sell dollars, then you get the right to sell dollars against LKR. That is the right that the buyer will get, either to buy the underlying, whatever. The underlying, in general market, the underlying can be many things, many financial instruments or variables. It can be, as I explained here, it can be exchange rate, can be a bond, can be a share or commodity like gold, oil, or something like that, any type of commodity. So this is the basic. The buyer of the option gets a right to buy the underlying or sell the underlying, but there's no obligation from the buyer side to buy that or sell that underlying. That's the basic.
Excuse me, sir, but on the other side, now let's say if the buyer or seller has the right, indirectly from
No.
other side.
Again, sorry, not the buyer or seller has the right. In option buyer gets the right. This is two things: buying the option and buying or selling the underlying. Two different things. In this example, dollar rupee example, the underlying is dollar rupee. Indeed, because we have to specify the currency pair. Underlying is dollars. The option is different thing. Option on US dollar. So there can be an option to buy dollars, or there can be an option to sell dollars. Clear? Either to buy dollars or either to sell dollars, you have to buy the option. You sell the option, then you get the obligation, but no right. You don't have any choice if you are a seller of an option. But if you are a buyer of an option, then you have the choice whether to exercise your right or not. Whether you exercise your right or not, it's up to you as the buyer of the option. As the seller of the option, you don't have that right. You have the obligation. If the buyer comes and say, I want to exercise my right, the option seller has to meet that obligation. Clear? Is it clear?
Yeah.
Okay. So don't get confused. That's very good. You have to be clear on that. What are you going to buy and sell? The underlying. And buying the option or selling the option. So in derivatives, you have the derivative product and the underlying product as two things, based on which we have created the derivative product. That is we call the underlying. Clear? Okay. When you buy an option, you get a right. So depending on that right, whether it's a right to buy or whether it's a right to sell, we use two different names. So remember, through a one option, you cannot get the right to buy and to get the right to sell. No. In one option, you will get either to buy or either to or to sell, not both. Remember? Is it clear? Sorry. You get only one of these. Only one. Depending on whether you get the right to buy or whether you get a right to sell, we differentiate those two as two different products. There are two different names given. But up to this point, what you have to understand is what is the difference between buying an option and buying or selling the underlying. If you buy the option, you get a right. Clear? If you buy the option, it's like you buy an insurance. Then you have the right to make a claim. Likewise, if you have bought a life insurance or health insurance or automobile insurance or fire insurance, you have a right. But what is the right? That depends on the type of the insurance you have. Similarly here, when you buy an option, you have the right. What is the right that you have depend on the type of the option that you have bought. In one type of option, you get the right to buy. On the other one, you get the right to sell the underlying. Clear? Any question? So if you get the right to buy the underlying, we call it a call option. If you get the right to buy the underlying, we call it as a call option. If you get the right to sell the underlying, we call it as a put option. So call option or put option. If you have bought a call option, what do you get? As a buyer, you have a right to do what? Right to buy the underlying. In a put option, as a buyer, you will get a right to sell the underlying. Clear? Buyer of the option will get a right. What is the right? That depends on whether you bought a call option or a put option. In a call option, you get the right to buy the underlying. In a put option, you get the right to sell the underlying. Is it clear? Is it clear, or you have some doubts, or it's not clear at all? Is it clear or not?
Okay, sir, it's okay.
It's okay. Okay. I hope everybody. So I repeat it. When you buy a call option, or I'll go other way around. There are two types of options: call option and a put option. As a buyer of a call option, buyer gets a right to buy the underlying. Here, in a call option, the buyer of the call option gets a right to buy the underlying. In a put option, remember, still buyer, not the seller. In both, buyer of the option gets a right to sell the underlying. Under put option, buyer of the option gets a right to sell the underlying. In a call option, buyer of the option gets a right to buy the underlying. Okay, this is clear. Now, when you say you buy something and you sell something, you need some more terms to be specified. What are those? When you say when you want to buy something, what are the things that you have to specify? if you go to a boutique, so will you say, I need some sugar? How do you say? I want to buy sugar. Would it be enough? What you have to tell or specify?
The quantity amount that you're buying.
Yes. You have to specify the quantity. What else in financial markets? What else? Because this is an agreement between two parties. So, okay, in my previous example, once you specify the quantity, the shop owner would tell you what other thing that
Price.
price. What's the price? In this, some of the goods, not only the quantity is enough, in some you may have to specify the quality as well. So those are characteristics of the underlying. So this I just omit this part, quality, but that has to be there. However, quantity you have to specify, price, and one more key variable is missing. What is that? Because you get a right to buy. You get a right to buy of this underlying and this quantity at this price. And the other question comes,
Which date?
which date? When are you going to buy? Time. So in an option contract, whether it's a call or a put, you have to specify what is the quantity, what is the price, and when. Whether you are going to buy or sell. Sell the underlying or buy the underlying. So in an option contract, the buyer gets a right to buy the underlying at a specified price and specified quantity on or before a specified date. In an call put option, option buyer gets a right to sell the underlying at a specified price, specified quantity, and on or before the specified date. Clear? So in a call option and put option, the common factors, these are common factors. Quantity, price, and when to do this. Indeed, this is the maturity date of this contract, when this contract is mature. But the difference in call and put is what is the right that you get, whether you get a right to buy or whether you get a right to sell. Call option, you get a right to buy. Put option, you get a right to sell. That's the shortest form, but you have to be clear in either of the contract, the quantity, price, and the timing you have to specify. So when I mention timing, I use the word on or before. On or before a specified date. You can exercise your right on or before a specified date. This is general statement to explain options. But again, based on this timing, so when you have the right to exercise your right, when you can exercise your right, depending on that, again we can divide options into two categories. Depending on the timing, we divide it as European option or American option. In the European option, you can exercise buyer can exercise his or her right only on the time being. I'll use maturity. Only on the last date on the maturity date. We call in option, we call it as expiry date. The word we use is expiry date in option. So if you buy an option, 3-month option, end of 3 months only you can exercise your right. That's under European option. Again, remember, I didn't specify what is the right, whether you have a right to buy or sell. That's different. That depends on whether it's a put or a call. But this European American differentiate when you have that right, depending on the time. In an European option, whether it's a call or a put, irrespective of that, you have your right only on the maturity date, on the expiry date. Before that, you cannot exercise your right. But in the American option, buyer can exercise, as I mentioned earlier, on or before, including the maturity date. Oh yes, that's right, on or before the maturity. So during the whole lifespan, the American option buyer has the right. He or she can exercise his or her right throughout that time period. But under the European option, the buyer can exercise his right only on the maturity date. Clear? Any question? So therefore, the European option, that again, that can be call or put. American option also, that can be a call or a put. What's the difference? In a European call option, the option buyer gets the right to buy the underlying asset on the maturity date. If it is a put option, the put option buyer gets the right to sell the underlying asset on the maturity date. But in an American style one, call option buyer gets the right to buy the underlying asset on or before the maturity date. Put option buyer will get the right to sell the asset for the underlying on or before the maturity date. That's the difference. So if I draw a timeline, this t equals 0, this is maturity. So the expiry date, American options can be exercised anytime in between these. American options can be exercised anytime But European option, only on this date, only on the maturity date. That's the difference. Whether it's a put option or a call option, irrespective of that, the buyer has the right to exercise his right anytime or no before maturity. But in a European style option, it's only on the maturity date. So going forward, I'll mostly discuss European option. Simply, it's the most common one and it's the simplest one. Okay, now I'll give you an example. Okay, assume you bought a call option .1 month. You bought a 1 month call option on USD LKR with strike 190. You bought a 1 month call option on USD LKR with a strike 190 to make it clear, European style. Now there's a new word. What is that? The strike. What does it mean, that strike? What's the meaning? That is the agreed price. The strike, in option jargon, it is the agreed price. So now you bought a call option, 1 month call option on dollar rupee with a strike of 190. What does it mean? After 90 days, today, you entered into this transaction, assume today. After 90 days, that means in 3 months' time, you can buy USD LKR. I forgot to mention, say 1 million. 1 million. You can buy USD LKR 1 million at 190 rupees per dollar. So that is the rights that you get on this date as a buyer of the option, because it's a call option. It doesn't say, when it says call option, it doesn't say you can buy. Just when you see that it's a call option, you should know that's a right to buy. So you get a right to buy dollar rupee. So you can buy dollar rupee 1 million at 190 on after 90 days time. Since it's a European style, in between this you can't do anything. What you have to do is just wait and see. Okay. Assume after 90 days, exchange rate is 195. What do? The exchange rate is 195. You have a right to buy at 190. Now what do? when the market is at 195, you have a chance to buy at 190. Would you like to buy from the market or exercise your right here? So I wrote it here. After 90 days, exchange rate is 195. On this day, the expiry date of the option, market exchange rate is 195. You have bought a contract to buy dollars at 190. What do you do? Remember, in the option, you have the right, but no obligation. So therefore, you can decide whether I should exercise this right or not. Now, in this instance, since the exchange rate, market rate is higher than your agreed price, you should exercise your right. You will call the counterparty, whoever who sold you the option, say, tell, I want to exercise my right. Then you can buy dollars at 190 without buying it at the market. Okay, what's the difference? The good thing is, assume instead of 195, the exchange rate is 185 after 90 days. On the maturity date or the expiry date, market exchange rate is 185. You have a right to buy at 190. What do you do? Will you pay 109 to buy 190 to buy, or you buy it at 185? Because under option contracts, you have the choice whether to do this or not as a buyer. So now it's up to you whether you buy at 190 or you buy it at the market price. If you are a rational person, you won't exercise your right here. You will buy it at the market price because you can buy it at a cheaper rate, 185. That's the flexibility given by options to the option buyer. This is not available in the forward contract. If you have agreed to buy dollars in 1 month forward at 190, whether the market rate is 195 or 185, irrespective of the market rate, you have to pay 190 and buy dollars. You have the right to buy $100 as well as you have the obligation. But in an option, as a buyer of the option contract, you don't have the obligation, but you have the right. So in this case, if the exchange rate is above 190, then only you will exercise your right and you buy it at 190. But if the exchange rate is below 185 on the maturity date, you won't exercise your right. You just forget about this contract and go to the market and buy 185. Clear? But now the question is, nobody will give you this sort of thing, option for free. Nobody will give you that for free. So to get this right, you have to pay a cost. That cost we call option premium. To buy that right, you pay the option premium to the option seller. So that is a small percentage of the notional amount that you have.
Excuse me, sir.
Yes.
It's a 1 month call option, right? So why
Yes.
are we keeping it for 90 days?
Sorry. Yes, it should be 30 days. You should have asked that at the beginning. Yes. This is 1 month. Then in this, that has to be 30 days. After 30 days, if your agreed price is 190, if the market is 195, you can buy it at 190. If the market rate is at 185, you can forget about your contract and buy it at 185 from the market. Sorry about that. So yes, since the contract is for 1 month, this has to be at the end of 30 days. Since it's a European, only on the expiry. That's the only change, is 30 days. But how do you take the decision? There's no difference. Clear? Any other question? Okay, let's see a put option. You got a 1 month European call on USD LKR at 194 1 million USD. So make it clear for you. With strike 194 1 million USD. So, sorry, okay. It's not a call, it should be a put. You bought a put option, 1 month put option, European style, with a strike 190 for 1 million USD. Now, after one month time, this is 190. What you can do, what you want to do. You have bought a put option. What do you want to do? You want to sell
Yes, sir.
dollars. That's why you buy a put option. Remember, you buy a put option. You buy a put option when you want to sell. You buy a put option when you want to sell. So since you have bought a put option here, you want to sell US dollar after 1 month's time. Okay. If the market rate is 195 and you agreed rate, the strike rate, we call it strike, and mostly denoted by H. When the strike is 190, market price is 195. What is your action? Now you have the right to sell it at 190 because you have bought a put option at 190. What do you do? On the expiry date of this option, market exchange rate is 195. Your agreed price is 190. What do you do?
We don't exercise option. We
Sorry?
sell in the market.
I didn't get that.
We don't exercise option since we
Yes.
can sell it for 195 in the market now.
Yes, you don't exercise your right because no point of doing that. You can sell your $1 million at 195. So why do you sell it at 109? So we call that, you don't exercise, we call it let it expire. We let the option to expire without doing anything, without exercising our right. But if the market is at 185, then what do you do? After 30 days time, the exchange rate is 185. You have bought a put option to sell it at 190. Now what? Will you exercise your right or not?
Exercise the rights.
You will exercise your right. What does it mean by that? You sell dollar at 190 per dollar. And who is the buyer? Who is going to buy that? It's not in the
Option
market.
seller.
The option seller. You have to go to the option seller and sell your dollars at 190. If it is a call option, you have to go to the option seller and buy from the option seller. And option seller has the obligation. The option seller cannot say, no, I cannot do, I don't want to do this. It's not possible. But even in this scenario, if you think, I don't want to buy dollars, I just forget about it, you can let it expire without doing anything. But rational person not do that. Sell it at 190 and buy it 185. You can make a profit straight away. But if you want, you can do that. Like in automobile, if the damage is, say, less than the no claim bonus amount, you won't exercise your right, is it? If the damage is just a scratch, maybe you can buy a polishing thing and wipe it out, then you don't make the claim. 1,000 rupees, 2,000 rupees, you may not claim automobile claim, is it? Likewise, that's the option you have. Likewise, here also, if you think, I don't want to do that, you may not do that. That's very rare. If you are rational, in this case, you should exercise your right when it is profitable. Clear? The option buyer has the right. He can make his decision. He has a choice. But the option seller does not have any choice. If the option buyer comes and says, I want to exercise my right, he has to meet that obligation, which is not in the forward contract. Forward contract, the buyer or the seller, both parties have the right and the obligation, both. But in this, option buyer has the flexibility to take the decision based on the market movements. So that flexibility won't get for free. You have to pay the premium for that. You pay the premium upfront. That means whenever you enter into the transaction, when you buy the option, you pay the E equals 0. This is the trade date. You pay, buyer. Buyer of the option pays the premium on this date. This is the expiry date. On this date only you take the decision whether to exercise your right or not. So you pay the premium upfront. Whether you will get a cash flow or not depends on your decision on this day based on the market prices. Clear? That basic. Any question? Any question? Okay, if you don't have any question, now think about if you have a long position in foreign exchange to hedge that risk, what you should do? Buy a call or buy a put. You have a
Buy a put.
you have a long position, you want to hedge it. Then what do? You buy a put. Why? When you say you have a long position, that means you have foreign currencies in your position. The risk is if the exchange rate moves down in a way that value of foreign currency goes down. To avoid that risk, you have to buy a put. Then you can sell it at a higher rate than the market rate. Then the opposite is true when you have a short position. If you have a short position, that means your requirement is to buy foreign currency. Whenever your requirement is to buy foreign currency, the risk is appreciation of foreign currency. If the exchange rate in dollar rupee terms, if exchange rate goes up, then you have to pay more rupees to buy dollars. To avoid that, what do? You enter into a call option. You buy a right to buy dollars in future specified date. So then you can hedge your position. That's the basic. If you have understood that, I think that's enough in this course so far. Any question? I can explain a little bit more on option, but before that, I'll show you a few example as well. What is your exposure and how to hedge it using option. Before that, let me know whether it's clear or not option. What is an option? Specifically, what's a call option? What's a put option? As a buyer, what do you get? As a buyer of a call option, what do you get? As a buyer of a put option, what do you get? Don't get confused with buying the option and buying the underlying or selling the underlying. Same thing, selling the option and buying or selling the underlying, two different things. So two different products. Buying one thing will give you a right to buy or sell something else. Buying the option will give you a right to buy or sell the underlying asset. Whether you get a buying right or selling right, that depends on whether you bought a call option or a put option. So first be clear on that. What is a call option? What's a put option? What's the right that you get as a buyer of the option? Then whether it's a American style or a European style, what is the difference in American style and the European style. Then as a buyer of a call option, when are you going to exercise your right? As a buyer of a put option, when are you going to exercise your right? That has to be clear. If
So in
it is-
American, sorry, in American option, sir, now there is no precise date, no. So within that time frame, we can exercise at whatever the time we want, right? Is it?
yes. Say in my previous example, the call option, the strike is at 190, 1 month call option. Say after 10 days exchange rate move up to 195, you can exercise your right and buy dollar rupee at 190 when the market is at 195. That can be done.
In
Yes.
Sri Lanka, you don't have options, is it? We don't have that kind of option market in Sri Lanka.
In Sri Lanka, we have option market. Not that liquid, but there's an option market. Small trades are taken place, but mostly European style.
So is it directly with the banks, or do they directly involve in foreign banks?
Among banks and with foreign banks, maybe back-to-back transaction. If they enter into a transaction, if it is not within NOP, they have to do a back-to-back transaction to cover up their exposure. They can banks do it with clients as well.
Okay, thank you.
So with that comment on the European option and the American option, what do you think about the premiums in American option and the European option? The European option gives you the right only at the end. American option gives you the right during that period. So what would be the relationship between premiums?
Premium must be high in your US options, no?
American option, yes. Premium in American option is high because you have the more flexibility. Exactly, that's what happened. American options are expensive than European options because you get more flexibility in American option. So if you go through the presentation, underline, that's the general terminology we use. Whatever the asset that we want to buy or sell, asset or maybe any other financial variable, we call it the underlying. And the strike price or the exercise price is the agreed price. In my example, that 190 is the strike price or the exercise price. Then the buyer or the holder or the owner of the option we call option long party. The seller of the option also called option writer. Mostly we call option writer, not option seller. Option writer is the one who sells the option. It's going short options, not the underlying. Remember, buyer goes long on option, seller goes short on option. The premium is a cost to the buyer of the option, and it is paid to the seller and non-returnable. At the end, even whether you exercise or not, you cannot claim that premium like in insurance. You make the premium for the year. At the end of the year, you haven't made any claim, but you cannot ask back for the premium. Similarly, the premium is once paid, it's paid. You cannot reclaim that. So the cost premium is cost to the buyer. That's the only income to the seller. Remember that. That's another thing. That's the only income to the seller of the option. He won't get anything. So it's paid by the buyer to the seller and non-returnable. So as I mentioned, call option most of the the best thing is always think from the buyer's perspective. Then the opposite is true for the seller other than the right. Buyer has the right, seller has no right. So in a call option, buyer has the right to buy an asset, the underlying, for a specified price and on or before a specified date, but that depends on whether it's a call option, American or a put. In a put option, right to sell an asset on a at a specified price, we call it strike price or the exercise price. Again, timing depends on whether it's a American or a European style. So American style any day, that's the easy way to remember. European on the expiry day or on the end, E4 end or expiry. This payoff, what does it mean? Okay, if I explain this, so any option there's a strike price. So this is a chart or a graph. In the x-axis, the price of the underlying is shown. On the y-axis, the profit is shown. Before we move into the profit, I just explain without profit what would happen. Say it's a long call option. You have bought a call option. This is the strike price. When the price of the underlying, assuming European style, when the price of the underlying is higher, that means when it falls into the right side from this strike price, what do? When the strike price is higher than the exercise price or the strike price, as a call option buyer, what do? You exercise your right. Say this is 190, our previous example. This is 195, somewhere here. What do? When the contracted price is 190, strike price is 190, market price is 195, you buy dollars by exercising your right at 190. Market is 195. So what is your gain? The difference here. So you should get a 5 rupees gain here. Clear? If it is 192, it should be somewhere here. You get 2 rupees. If it is 200, you get something 10 rupees. So from this point and onwards, your payoff will increase like this. It should be a straight line. Sorry. 1 rupee increase in exchange rate, you make a 1 rupee gain. But what would happen if the exchange rate remains below 190? You won't exercise your right. So you won't get any cash flow. 0. So therefore it will be like this. So the actual payoff diagram would be like this. Below the exercise price, it will be 0. After exercise price, after the strike price, it will increase on a 1-to-1 basis. When the underlying price increase by 1, your payoff will increase by 1. That means you get a 1 rupee cash. This is the payoff. But here the x-axis, y-axis shows the profit. What is your profit? Your profit is different from your payoff. Why? To buy this option, you have paid a premium. That is a cost for you. So that premium is deducted. So before, when the price is lower than the strike price, you incur a loss. The amount of that loss is limited to the premium, but after that you will start to exercise your right. Your loss will be minimized or will be lower, but after some time it will start to give a profit. So this is the profit diagram. The one I wrote is the payoff diagram. So if I delete all these things, this line is the profit diagram. And there's another so in a long call option, you can see maximum loss is the premium, maximum profit is unlimited. When the price goes up, your profit goes up. There's no limit. Break-even price, that means where you get zero profit is, this is the strike price. You add that premium, you get the break-even price. You can do the same thing for a put option as well. Before that, this explains what would happen for a short call option. That means for a seller, it is just the mirror image of this graph. If you keep a mirror on this, you would see something like this. That's the payoff for the profit diagram for the option seller. It's shown in this. In here you can see, as I mentioned earlier, option seller income is, or the profit is just the premium, but you can see loss, it can be huge, no limit. So selling an option is very risky. So maximum loss is unlimited, but the maximum profit is premium. Again, break-even price is strike price plus the premium. You can do the same for the put option, but it's other way. The difference is you make profit when price falls down. You make loss when price increases, but that loss is capped at the level of premium that you paid. The again mirror image on the x-axis is the payoff for the option seller, put option seller. So again, maximum loss, you can say strike price minus premium, because price cannot go below zero. Price cannot go below zero. When price falls back to zero, so this would be the maximum loss. So all these four positions, whether it's a long call, that means you buy a call or you sell a call, you buy a put or you sell a put, can be used as a hedging instrument. But
Sorry, why do you call it a long call and a short call? I didn't get that part.
the long call means you have bought a call. If you have sold the call option, then it's a short call. Either you can buy the call option or you can sell the call option. You can be the writer. That can be done. Whenever you buy, there should be some party to sell. No?
Both sides are considered.
Both sides is there. So this is the long party, this is the short party. That means this is the buyer,
Basically, it's from a buyer's perspective and a seller's perspective.
Seller's perspective, yes. What I'm telling here is to hedge your position, it not necessarily to buy an option. You can hedge your position by selling an option as well. You can sell a call option to hedge, or you can sell a put option to hedge your position. That depends on your position, but to discuss, I don't think we have time now how you can hedge your position by selling a call or a put. But as we discussed earlier, when you have a long exposure, so can straight away say it. You go long when your exposure is short. Okay, this is the exposure. You buy a call option when your exposure is short. You sell a call when you have a long position. This is your position, not the option position, sorry, your underlying position. You buy a put when you have a long position. You sell a put when you have a short position. But remember, this one and this one, it may not hedge exactly. Only up to some extent you can hedge using short call or short put, depending on your position. But when you are short, if you buy a call option, it will hedge much better. When you have a long position, you buy a put, that will hedge your position properly. So however, all these three, or four, sorry, all these four can be used to hedge your position. So this is what I explained earlier. When you have a long underline what you do, either sell a call option or a buy a put option. But in this option, there are some lapses. If you go for a buy in a put option, it may not become, sorry, not that one, sell a call option. This is perfectly okay. This, there may be some lapses. You may not be able to hedge your position exactly, because when you sell a call option, you get only the premium. Beyond that, you are still exposed. Okay, this is an example. A Sri Lankan tea exporter. Will he get a positive for the long position or a short position in foreign currencies? Sri Lankan exporter, he will get a long position because he is receiving foreign currency. So when he is receiving foreign currency, his risk is if rupee strengthens. That means exchange rate goes down. So that's the risk. So what I'm telling, looking at the scenario, you should be able to exactly identify what is the risk, whether currency appreciation or the dollar appreciation or the dollar depreciation. That you have to identify properly before you decide the way of hedging. So in that exporter scenario, he's having a long position. So rupee strengthening is the risk. What he can do, buy a put with a strike of 155. It not necessarily be to be the current exchange rate. It may be slightly different, but you buy a put, because when you have a long position, what you want to do, you have to sell that to cover your position. So you buy a put. Then what would happen? At this rate, $1 million equal to 155 million rupees. If it goes down to 154, it will worth only 154 million. If it goes up to 156, it will worth only 156 million rupees. To the right, dollar weak. Sorry, to the right it should be dollar strengthen, and to the left, dollar weaken. So what is the risk for the exporter is this dollar weakening or rupee strengthen. So that's why he has to buy a put option. So what would be the outcome? If dollar strengthen, that means market moves this way. As an exporter, would you prefer that or not? You prefer that. If the exchange rate goes up from 155 to 156 or 160, you prefer. So the put option, no value for the put option, you let it expire. You sell 1 million at the market rate. But in the scenario 2, if the dollar weaken, that means rupee appreciate, then the problem comes. Value of your dollars in rupees eroded. So, but you have bought a put option. When the market price is 154, you can sell it at 155. So you will exercise your right. So as I mentioned, the other option, if you, so ultimately the long put option will give you protection and addition. Yes, in a put option, you are perfectly hedged, because the 1 rupee drop in the exchange rate, you are covered, because you can sell it at 155. Now we'll move into the importer scenario. Importer is having a short position because he has to buy dollars, or what in this example, yen. So the risk is if yen strengthens, he has to buy yen. Then if he wants to hedge his position using an option contract, what he has to do, buy a call option. Assume he bought a call option with a strike of 1.17. What does it mean by strike 1.17? The agreed price is 1.17 rupees per yen. What would be the outcome? This is 1.117. Say this is 1.2. This is 1.15. When are you going to exercise your right? When the exchange rate is at 1.15 or when the exchange rate is at 1.2? when are you going to exercise your right?
When the
In
rate is
scenario 1 or in scenario 2?
1.2.
In scenario 2, when the exchange rate is at 1.2, because you are a buyer of yen. You don't want to pay 1.2, whereas you can buy it at 1.17. So you will exercise your right. So you are completely protected. Clear? So I think that's enough for you. About options, you will discuss more in the derivatives, and you will get to know more terminology and things. But so far, I think you are clear when to buy a call option and when to buy a put option to hedge your position. Basically, irrespective of the underlying, whether it's FX or something else, if you have a long position, if you have a short position in the underlying, what you should do? Buy a call option. If you have a long position in the underlying, buy a put option. Just remember that these two also can be used, but it may not hedge your position exactly. There will be some limitations. Any question? I hope you are clear about what is a call option from the buyer's perspective, what's a call option and what's a put option, and when to exercise your right, in under which scenario you exercise your right of a call option or a put option. Then depending on your position, whether you are short on the underlying or whether you are long on the underlying, what is the option that you have to buy, whether it's a call option or a put option. If you are clear about that, I think that would be enough for the time being. Any question? Oh, there's an announcement. I forgot it. Luckily, it came into my mind now. Next week, there won't be any classes. Is it clear? Next week, there won't be any classes. The next class will be held on 3rd January. Is it clear? That announcement? Okay.
Yes, sir. Yes.
What about other things? Are those clear? Go through the slides. But don't worry about this slide. It's not relevant to this. Basically, these two. When you should go long on a call option, when you should go long on a put option. Short position. When you have a short position, you go long call. When you have a long position, you go long on put. That means when you have a short position, you buy a call option. When you have a long position, you buy a put option. That's the basic strategy. What are the advantages over forwards? Buyer gets the flexibility. The disadvantage is we have to pay the premium. It may be wasted. Okay, then any question before we stop? If you don't have any questions, we'll stop here. Is it okay? Shall we stop here?
Okay, sir.
Okay, but I hope you get something about foreign exchange market and how to identify foreign exchange rate risk, and how to use forward transactions, swap, and options to hedge that position. The basic, not the very sophisticated knowledge, but at least the basic. And you have an exam also, no? So at the exam, be sure that you answer the question asked. Don't write unnecessary things. If you know the subject, you can provide short and sweet answers. No need to write lengthy answers, at least in this part. When I ask what is the risk, don't write FX risk. Tell me whether appreciation of whatever the currency or what depreciation of the currency is the risk. Tell me exactly what is that risk, whether it's appreciation or the depreciation, whether it's economic risk or the translation risk or the transaction risk.
It's okay.
Then when you try to hedge the position, tell me whether you are buying or whether you are selling that, and for what period, things like that. Without just saying you can use options. Say options, you can use options or you can use forwards. It's not enough. You have to tell whether you buy forward or whether you sell forward, whether you buy a put option or whether you buy a call option. You have to be specific on that when you answer. Otherwise, it's incomplete, and I feel like you haven't understood or you don't have the necessary knowledge on the subject. So keep it in that your mind. So hopefully we won't meet again in this course probably. So all the best. If you have any questions, you can ask. If not, we can stop here. And again, repeat that announcement. Next week, there are no classes. The next class will be held on 3rd of January. Any questions?
So can we get the email address or a number if we find any questions in the future? I think when we start to do work, we'll get questions. And some questions will also be very good, sir, if you can give us some questions as well as in for our homework.
Okay, I'll try. Have you access to past papers? Have you got access to past papers? Yes or no?
No, not yet.
Not yet. You will get it. See. This is my email address, ishanta@cbsl.lk. So you can contact me through that. About questions, okay, I'll discuss. If you have access to past papers, yes, at least last 3 years, I prepared the question with regard to FX part, so you can refer those as well. If you don't have access,
Can you tell Mr. Manager to upload that?
yes, I'll check with that manager. If they don't have post it, I'll give some different examples or the questions, sample questions. We'll do that. It is possible. I'll do that. Anything else? Okay, then we'll stop here. Thank you very much for listening and all the best.